EastWest Capital is priced below book. The proposed 9 billion peso rights offering is set against a price-to-book value of 0.3052 times. Dividends may take a back seat. This presentation examines why the raise is awkward, why the bank is doing it, and what it could mean for the 7.4% yield. A preemptive capital buffer can still reduce near-term per share value when shares trade far below book. The proposed rights offer is 9 billion pesos at a price-to-book value of 0.3052 times, against a June CET1 ratio of 11.7% and a trailing dividend yield of 7.4%. The raise improves loss-absorbing capital and restores strategic capacity. But selling equity at roughly 31 centavos per peso of reported book value creates heavy dilution unless the new capital earns strong returns. The benefit is more CET1, more growth capacity, and more shock absorption. The shareholder cost is lower BVPS, initial EPS dilution, and dividend uncertainty. Good prudence is not automatically good capital allocation. Cash enters the bank, yet book value per share falls because too many discounted shares must be issued. In an illustrative 9 billion peso issue at 11 pesos and 8 centavos, pre-raise BVPS is 36 pesos and 31 centavos. About 812 million new shares would be issued, producing post-raise BVPS of 29 pesos and 62 centavos, or about 18% BVPS dilution. At subscription prices of 14, 12, 11 pesos and 8 centavos, 10 pesos and 8 pesos, the illustrative dilution is 13.7%, 16.7%, 18.4%, 20.7%, and 26%, respectively. A lower subscription price means more shares and greater dilution. A rights offer preserves ownership percentage only for investors who contribute additional cash. It does not prevent BVPS or near-term EPS dilution. The first half balance sheet shows three converging pressures on common equity. First, capital is adequate, not generous. CAR is 12.5% and CET1 is 11.7%. These are above minimums, but with limited room for consumer credit volatility and expansion. Second, assets outrun equity. Assets rose 46.8 billion pesos in 6 months, while equity increased only 142 million pesos. Third, provisions slowed capital formation. 10.1 billion pesos of first-half provisions absorbed about 70% of pre-provision operating profit. The rights issue is best read as a preemptive recapitalization, growth capital with a defensive buffer. Income was almost entirely offset by dividends and market value movements. Equity was 81.5 billion pesos in December 2025. Net income added 3.42 billion pesos, while dividends reduced equity by 1.84 billion pesos and other comprehensive loss reduced it by 1.43 billion pesos. By June 2026, equity was 81.7 billion pesos. The result, balance sheet capacity expanded, but common equity did not. No suspension has been announced. The economics nevertheless become harder after a large rights issue. The current annual dividend cost is 1.845 billion pesos. Illustratively, that cost would rise to 2.51 billion pesos if 0.82 pesos per share were maintained on 3.06 billion post-issue shares. The bank could maintain 0.82 pesos per share, keep total cash outflow flat, and reduce the dividend to about 0.60 pesos per share, or retain more earnings. Retaining more earnings is most conservative for capital and weakest for income investors. Capital preservation may outrank yield until provisions normalize and the new equity is deployed. The bank must earn its way out of dilution. First, rights fairness requires tradable rights, equal terms, and transparent oversubscription allocation. Second, credit clarity requires better disclosure of non-performing loans, coverage, stage migration, write-offs, and product-level delinquency. Third, the bank needs a credible path back to at least 10 to 12% return on equity after the new capital is deployed. Fourth, it should provide specific allocations of proceeds to loan growth, secured assets, wealth, digital, and capital buffers. Fifth, investors need a target dividend payout framework so they can price the income trade-off. Sixth, execution speed matters. New capital must become productive before idle equity depresses ROE for years. The transaction succeeds only if future EPS, BVPS, and dividend capacity exceed the no-raise path. The raise can be sensible banking and still be an expensive deal for shareholders. It helps by restoring CET1 headroom, supporting growth and technology investment, adding protection against consumer credit losses, and using an FDC backstop to reduce execution risk. It hurts because shares may be issued near 0.31 times book, creating immediate BVPS and EPS dilution. Investors must add cash to avoid ownership dilution, and dividend growth may pause or reverse. Watch the rights price, entitlement ratio, tradability, post-raise CET1, credit costs, and 2027 dividend policy. Capital comes first. The bargain thesis now depends on execution.